During these market downturns, we obviously see stocks down, crypto, real estate, bond. I mean, just everything is going down, and it goes back to this idea. It's all one trade. The Fed's in control, and they're going to drive this stuff down until they feel like people have capitulated. What are institutional investors thinking about right now when they're watching this play out? Obviously, they have some direct investing. They have probably much more kind of investing through general partners and through fund managers. But like, what's going through the heads of these institutional investors right now?
So it's a great question that you have to answer it in pieces. There are really great institutional investors. I was just with the Fairfax folks that you and I know well last Thursday up in DC. So think about this. In the midst of all of this turmoil, markets crashing, you said, every asset going down, they called together all of their private investors, venture capital, growth equity, buyouts, energy, and put us all in a room together for a day on Thursday and just had a massive idea session. Genius, right? Take people you're paying lots of money to do smart things for you. And let's see if there's some opportunities that come out of all this turmoil. And they got some really good ideas. So the really smart ones, like Catherine and Andy, are going to do that kind of stuff. The less smart ones are going to do what human beings do. Human beings do two things really, really well. We buy what we wish we would have bought, and we sell what we're about to need. And you and I debated this morning, actually. So the problem with most investors, and institutions a little bit less, but they're just as guilty as the individuals. The individuals are the worst about this, right? They constantly buy the top and then they sell the bottom. But the institutions also chase hot dots. And so there are some institutions that are looking around saying, well, there are no hot dots. So what do I do? So they are probably selling some things like all the nasty stuff about the hedge funds and the Tiger Cubs and all that stuff. There are people that are going to try to redeem from those things. That's probably a mistake. One of the things about investing that I tried to live, and I was actually decent at it, but not perfect. But what you should do, you should never buy something that has had a hot 3-year period. You should sell that because it's going to mean revert. What you should do is find somebody who has a great 10-year track record, who's just had a terrible 1, 2, 3-year run. And the worse, the better, and give that person money. So there are some that are out there doing that. And those are the real geniuses. I think the last thing is, I think something that's being talked about at the institutional level a lot right now is the same thing that's being talked about at the individual level, which is, well, wait a second, this is different. What about all these assets that were supposed to be uncorrelated? Why are they all going down at the same time? I thought bonds were supposed to not go down if stocks went down. They're supposed to be a safe haven. I thought gold was supposed to be a safe haven. I thought, crypto is supposed to be a safe haven. I thought international stocks weren't supposed to be correlated with US stocks. Well, here's the problem. The everything bubble, which was the result of the excessive central bank liquidity around the world, caused all assets to move to Stupidville, right? You mentioned the market cap to GDP, right? Worse than 2000, price to sales ratio, worse than 2000. So equities got to Stupidville. Bonds, listen to Greg Foss on Twitter, right? Rail about this, got to Stupidville. And everything, commodities and all of it went up. And so what happened is when they cut off the liquidity, the first thing started to correct. Well, the problem this time was people didn't just buy with cash, they bought with margin. Everybody bought with margin. Even some of the institutions bought with margin because the Goldman Sachs's and others for JP were giving them margin. And so we had the highest margin ever in history. Well, when you get a margin call, right, your stock falls 20%, you get a margin call, you're supposed to put in more money. You don't get to sell what you want to sell. You sell what you have to sell. You sell what's most liquid. So that's what causes everything to fall. And you saw it in March of 2020, and you've seen it in the last 2-3 weeks here. And when that starts to happen, people start questioning the whole theory of diversification. Now, Markowitz won the Nobel Prize, and I have a t-shirt that says Markowitz was right, and it does work. But in the short run, it gets temporarily suspended. And I think that does prompt some people to make bad decisions. So you got to avoid that urge to make those bad decisions. And I've said this to many other times, but investing, I think literally is the only business I know when things go on sale, people run out of the store. And the cheaper the price, the further they run. Think about any other business. You put wedding dresses on sale, they all run in the store. They don't run out of the store. They run in the store.
When you think about prices going up of assets, there's lots of talk about hold them, they're compounding, the Charlie Munger, Warren Buffett never interrupt compounding unnecessarily. Then there's another school of thought of rebalancing and kind of hitting your allocation target percentages, et cetera. What do the institutions do on the way down? Are they rebalancing? Are they trying to take, let's say, a pension fund as an example? Like, do they try to maybe not pay out as fast? Or what are like the tactical things that they do on the way down that maybe people aren't aware of, where they're trying to essentially stop the bleeding maybe, or at least address the problem?
Yep. Now, again, two really important points. So one is the rebalancing. The good ones, right? The Swenson acolytes, et cetera, rest in peace, David. They do rebalance. And that was something that I was always really proud of the way we did that at Carolina and at Notre Dame is we were very active rebalancers, because when you're in the endowment business or the pension business, you're not in the get rich business. Concentration makes you rich. Diversification keeps you rich, and rebalancing keeps you richer because you're constantly buying cheap and selling dear. All great fortunes in the world came from concentration. How do you create a small fortune? Start with a large fortune and stay concentrated. So there will always be cycles. And if you can hold forever, right, in a tax deferred structure like Berkshire, you should do that. And you should lever up. That's what they do. But most people should just constantly rebalance with a good plan. They should have some get rich money. I would say you should have 3 buckets: liquidity bucket to fund your lifestyle, a get rich bucket to do all the fun stuff, the friend's condo deal, the brother-in-law's venture deal. You're going to lose it all anyway, so just make it small. And then the stay rich bucket. Diversify that. And these institutions are looking at that stay rich bucket and saying, okay, my equities just fell a lot. My tech equities fell more. Let's go buy some stuff that's on sale. Maybe buy some Chinese equities. Maybe buy some of these cloud companies, although I think the cloud companies are still too expensive. Then on the flip side, they're looking at their private port. And here's the one problem. The very best of the very best, the Yales, the Notre Dames, the UNCs, et cetera, the very best of the very best in performance, they have this lag problem. The public markets adjust immediately, and then you have a denominator problem because your private markets don't adjust. And so you have a denominator problem in that your total fund value went down. So your weighting in private went up, but you can't really sell unless you sell in the secondary market. And then you're going to take a massive haircut because there's very little liquidity. So doing that doesn't make any sense. So you have to actually talk to your GPs and say, well, how far are valuations actually going to fall? Because they're going to fall, but they'll be sticky down instead of immediate. Because in private, it's the escalator up. In public, it's the escalator up and the elevator down, right? In the private world, it's the escalator up and the escalator down. It just takes longer to come down.